Check the syllabus. You will see that we still have, even if the portfolio theory, there is portfolio theory in FM and in advanced strategic financial management. There is cash forecast, that is forecasting, cash planning in FM and professional. Now, this is the strategy. I have a pre-recorded video on portfolio theory. Class, portfolio theory. So I will add the pre-recorded video in the playlist, SFM playlist. So that you, then I will equally send the material. Yes, I will share the material. So please, I'm not taking portfolio theory in class. I have a pre-recorded video, well detailed. In fact, if you listen to it, you will know that it covers the portfolio theory. Right. So I will assume that I've covered portfolio theory. So I will still check for cash planning, which is forecast. Because after option pricing, we should be looking at the free cash flow, the merger and acquisition, the valuation of the business. The free cash flow is the method of valuation. The merger and acquisition is the method of valuation. Economic value is a method of valuation. Shareholder value analysis is a method of valuation. Market value analysis is the method of valuation. Then before the capital reconstruction, because that capital reconstruction as well, the longer I can test capital reconstruction and reorganization. So I think we still have like 4 to 5 topics in SFM. So I may not touch, most likely I will not touch the risk management part of it, which is the part of hedging. Although we will use some of these terms in international investments. Of course, we'll use some of the hedging tools in international. So I will assume that we have covered portfolio theory. Immediately after this class, I will share the what is it called? I will add the portfolio theory to the playlist and in the Google Drive. Thank you. So can we move? Can we move now?
Yes, sir.
We move. So we're good to go.
Okay. Okay, that's fine. Now, option pricing and valuation. The question is, what is option? Option is the right to buy or sell an underlying asset at a specific price for a specific period of time. Class, you have the right to buy or you sell an underlying asset, but not obligation. You can decide to buy. You can decide to sell an underlying asset at a specific price and at a particular period of time. Class, we have an option market. Option market is different from the stock market. Class, option market is different from the stock market. And what is where and what is an option market? Is a place where you hedge against the fluctuation of investment risk. We should not forget, in the capital markets, you don't have hedging. In the capital market where you have shares. Class, let me take it again. An option is the right to buy an underlying asset at a specific price and a specific period of time. Class. And the question, before I move further to option markets, the question is, what is underlying assets? The underlying asset could be stocks, bonds, currencies, commodities, and various kinds of financial instruments. That is an underlying asset, meaning that you have the right to buy and you have the right to sell an underlying asset. An option market or option market is real. Class, option theory and valuation is another interesting topic. Now, where do we have what we call an option market. An option market is different from the stock market. Option market is a place where investors hedge or protect their investments against the fluctuation of investment risk. If you check FS trading, what's happening to something is wrong. Okay, a minute, please. Something is wrong. Okay. Class, are we still together? Class, are we still together? Hello?
Yes, sir.
Yes. Yes, sir. We are
Hello? Okay. I needed to confirm because of my network, right? Thank you. Meaning that you can go to the option market to buy stocks, bond, commodity, the currency, the foreign currency, to hedge against the fluctuation of investment risk. Class, we have the underlying assets. Then we have the option market. The option market is different from the stock market class. We will get there, right? Now, there are two classes of options. There are two classes of options. One, the call option. The question is, what is call option? The call option gives the right, gives the holder the rights, but not an obligation to buy an underlying asset at a specified price, that is exercise price or strike price, within a specific period of time. Meaning that call is an option to buy. You can go to the option market to buy, not an obligation. You can go there to buy or sell aligning assets at a specified price, meaning that at an exercise, the price you are willing to pay at a future date, we'll get there within a specific period of time. So Peter can go to the option market, maybe to buy shares from First Bank. As of today, today's date is 6th of August, 6th of September. And exercise is to exercise his rights to buy an option or to buy a stock in First Bank in an option market class. Maybe you can, as of today, what is the First Bank shares? You can go there to exercise your rights to hedge the price, the market price of First Bank shares. Right? Right? Mr. Peter can decide to buy, to go there to buy, right? To exercise, maybe at that current price, right? And at 20 naira per share in the option markets. Then maybe at the end of December, even if we'll get there, let me don't explain to the payoff table. Let's just continue with this. Class, call option is an option to buy at a specific price, which is the exercise price. You can decide to exercise your rights to buy an option, right? To buy an underlying asset in the option markets. Having explained this, what is put option? Put option gives the holder the rights, but not an obligation. It is not compulsory for you to exercise your rights to sell an underlying asset at a specified price. A specified price is the exercise price in the future time period or at a specific period. Meaning that Mr. Temitope can go to the option market to exercise its right to buy First Bank shares at the current price, right? Then, and sell at the later date. You can go there to exercise your right to sell. Class, to sell. So, put option is an option to sell. Class. In the option markets, there is what we call option premium. Class. In the stock market first, when you buy a shares in any of either the financial when you buy a shares, in the process of buying that share, there is what we call transaction costs. Of course, whether you are buying or you are selling shares, you have to incur a cost in the stock markets called transaction costs. Class. In the option markets, you can have what we call option premium. Whether or not you exercise your rights or not, whether you decide to exercise your rights to sell or to buy an underlying asset, or whether you exercise your rights or not, there is an option premium. An option premium could be traced to a transaction cost under the stock market, whether it is call or put. Plus, the option contract involves the payment of a premium. That is option premium. It is a cost. Whether you sell or not, the rights is exercised. Premium, whether or not the right is exercised, you have to pay an option premium. Whether it is for call, you want to buy, or whether it is for put, you want to sell. Plus, next, option terminologies that we may see as we move. Number one, option writer. Class. Who is an option writer? The person, the seller of the option. Class. Mr. Peter, go to the, maybe he went to, maybe he go to the what is it called, the option market today to exercise his rights to buy. You will buy from somewhere, right? You will buy from somewhere. So the person, the seller of the option, right, is called option writer. Plus, is called what? Option writer. That is the reason why you will see in the market, they will say the language in the option market, I want to sell, I want to short these underlying assets. When you say you want to short these underlying assets, means that you want to sell in the option markets. When you say you want to long, it means you want to buy. Then who is an option holder? The buyer of an option. When you want to long, you say you want to long these underlying assets. That is the terms. Next, we have exercise price. The question is, What is exercise price? It is also known as strike price. The predetermined price you are willing to buy or to sell an underlying asset. In an option market, Mr. Peter approached First Bank to exercise his rights at the current price to buy an option, to buy an underlying asset, stock. Right. The current price, as of today, it is what we call the exercise price. The price you will be willing to pay for that underlying assets, or the price at which the seller is willing to sell the underlying asset, is called an exercise price, or a stock, or a strike price. Plus, we have what we call option premium. The amount of money an option buyer pays. Of course, class, when you go to the option markets, whether or not you exercise your rights, you will pay what we call option premium. In the stock market, we have a transaction cost. Whether you buy or you sell a stock. But option market is different from a stock market. In an option market, you can hedge against the fluctuation of what investment risk. But in the stock market, no. And in an option market, we have some guys called speculators. They can predict what will happen. They will tell you, let's do it this way. They are there, right? Class, are we tired?
No, sir. No, sir.
Fire down, fire down.
Ah,
Fire up, fire up.
Ahead,
I
ahead.
don't get tired. Network. I don't know what happened to my network today. What happened? Hello, hello, class. Are we still together?
Yes.
Yes, sir. Yes, sir.
Okay. Okay. Okay, that's fine. I don't know what happened to my network. I don't know. Okay, let me just. So next, American versus European option. Plus, American versus European option. An American option can be exercised your rights anytime from initiation of the option contract up to the maturity of the option. Meaning that at any point, you can start your option, right? You can exercise your rights from the beginning of, from where you say, as of today, you exercise your rights to buy an option. And you said, maybe at the end of January or at the end of December, you will sell or you will buy more of the option, or you will sell the option at the underlying assets at the end of December. So you can decide to exercise your rights within that range. You can decide to sell or you buy more within that range. network. But for the European option, minutes. Thank you.
Am I the only one that is not hearing Mr. James? Mr. Ibrahim?
You are not alone. You are not alone. I think you are having network issue.
Okay, thank you so much.
Hello, class. So I think we have to stop here, right? I don't know what happened to my network. I don't know. It's so. Hello, class.
You can hear you,
Hello,
sir.
sir. Welcome back.
Hello.
Hello, sir.
Hello.
Hello.
Hi.
Okay.
Sir.
Okay. So I don't know what happened to my network, right? So in our next class, we'll continue. Where did we stop? Right? 5 American and European options, right?
You might even start afresh.
Yes,
Hello,
sir.
class. I mean, start afresh. I mean, even start afresh. Okay. But I wanted to complete this introduction, but I don't know what happened. What is happening to my network? I'm
He's
trying
hungry.
to.
He's hungry like you.
So before we go, we have an option market where you can buy and sell an underlying asset, right? An option market is the market where investors can hedge their investments against the fluctuation of investment risk. Then we have the call option is an option to buy an underlying asset at a specified price. And put option is an option to sell an underlying asset, but not an obligation, at a specified price. The specified price is the exercise price. Then we have the American versus European option. The way American options works is that if you go to the market, the option markets, to exercise your rights, before the expiration dates, of course, because you can say that, okay, you buy this option today. What is the current price of First Bank shares in the market? Maybe 90 naira per share, right? And you said, oh, you will exercise your rights, or you will sell this rights at the end of December. Now, in American option, before the end of that December, you can exercise your right to sell it before the expiration date, or before the maturity date. Class, you can exercise anytime from the date you initiate the option to up to the date of maturity. You can decide to sell before that December. Class, that is American option. However, European options, it can only be exercised at the expiration, at the maturity. And that is what we practice in Nigeria. European style option. European style option, or European what? Option. Meaning that if Mr. Peter approach First Bank in an option market to buy the stock, the shares as of today at this price, and he will now say, oh, I will sell it at the end of December, right? What he is trying to hedge, he is trying to protect its investment against fluctuation. You can't do that in the stock market. When you buy shares now, the share price may increase or decrease. Now you know that one. Is that not so? You can't do anything in the stock market. You can't hedge. You can only analyze. Right? Then Mr. Peter now will ask, oh, I will sell this rights in December. because of dirty December now, Christmas. Maybe as at today price is 100 naira per share. Then Mr. Peter will now exercise his rights to sell at the end of December. But the question now is, will Mr. Peter will it be in the money or out of the money or at the money? That is another thing we need to look at. And what is all these jargons? It means that if Mr. Peter decides to exercise his rights in December to sell, what if the market price has increased to 90 naira, to 500 naira, and he bought it at 100 naira in January or in September 6th? Then in December, the price has increased to 500. Mr. Peter can decide to exercise his right to sell that option. Therefore, Mr. Peter will be in the money, because the difference between what you have now, what you exercise at 100 naira and 500, you can decide, you sell. Will be in the money. Just make a profit. And that is what they do in the option market. You can check FS trading. It's real. But what you are doing now, everybody, we have needs. We have where we are working and we have what we do. So if your workplace is not in line with anything that has to do with asset management, security, merger and acquisition, and investment analysis, you don't even know. But in SFM, we just, as a consultant, you need to know all this, because what if your client approach you that this is what he wants to do? So what will you do? You have to have the knowledge, right? So my point here is European option, it can only be exercised at the expiration, at the date we say, oh, you will sell this right. You cannot sell it within that range, within that period. That is European option. Now, this will take us to the concepts before we go. The concept of moneyness of an option. This will take us to the concept of moneyness of an option. Moneyness of an option refers to whether the option is profitable. Moneyness, whether the option is profitable or not. Whether the option is at break even or no, whether the option is profitable at break even or at loss. That is moneyness. Now, in the money class, in the money, a call option, we should not forget that a call option is an option to buy. Is said to be in the money when the price of the underlying assets at maturity is greater than the exercise price. You can say Mr. Peter is in the money when the underlying asset. We will illustrate this under the payoff table. Yes, under the payoff table class. You are in the money, an investor is in the money, or a call option is in the money where the underlying assets, which is maybe stock at maturity, is greater than what the exercise price. Just like Mr. Peter approached First Bank in an option market to exercise his rights to buy. Class, to exercise his rights to buy. And what? To buy an option. Is that also? Then you exercise your rights to buy an option of 50 naira. Then in a later date, it becomes 60 naira or 100 naira. Mr. Peter is in the money. On the other hand, put option is in the money when underlying assets is less than the exercise price. The underlying asset in this concept is your, meaning that if the underlying assets is 50 and you have exercised your rights at the beginning that to be 30 naira, that at the end of the maturity, right? At the end of the maturity, what will be the underlying asset price? If it is less than the exercise price, you are in the money. Okay. A put option is an option to sell. You exercise your price. You have, let's say, we'll get there. When we get the put option, we still have what we call what is called intrinsic value and the rest, right? Now at the money class, at the money, if the price, an option is at the money, if the price of the underlying asset price, that is the stock price, and the exercise price is equal, is at par, whether call option or pull option, you can say the option is at the money, meaning that you exercise your right to buy First Bank shares in the option markets today at 15 naira class. Now, at the date of maturity, you now say, oh, you will sell this in December to do dirty December now. What is it called? Christmas and all that. Network. Wow. Right? To do dirty December. Then, as at the date of maturity, what is the underlying asset price? You exercise your price to be 50 naira. To say, oh, you buy this, you in the option market, and so you buy this at 50 naira. Then, at the date of maturity, which is December, that you are planning to do cash out, then you still have the market price as at then, maybe it's still 30 naira. Class, can you see? They are at par, whether it is call or whether it is put option. So you can say Mr. Peter is at the money. But when you make a loss in the stock market, in the option market, when you make a loss in the option in the option market, you can say Mr. Peter is out of the money. And how does it work? The price of an underlying asset at maturity is less than the exercise price. The call option is out of the money. What is call option? A call option is an option to buy. You have exercised your rights in August, 6th of September, to buy UBA shares at 50 naira in the option market. And or you've exercised your right to buy. Yes, let me use that word, to buy. Because call option is an option to buy. to buy the stock in the option market in December, maybe to buy it at 15 naira. You exercise your right to buy that shares 15 naira. That is the exercise price. Then in December, class, in December, you now have, let's say, you now have 20 naira. Class, you've exercised your rights. Please, option theory and valuation is practicable, is real in option markets. The more you understand this, the more you can be able to, the more you will be able to, because you can check either May 2024 or November 2025. You can check examiner comments under the theory, under the option price. Option payoff table. That is the reason why you need to understand the terminologies, because it may be used in the scenario. Is it out of the money? Is it in the money? Is it at the money? Class, you've exercised your right, Mr. Peter. He exercised his right to buy an option, to buy First Bank shares in an option market in December, maybe at 30 naira. Then in December, the underlying asset becomes 20 naira. You've already said you will buy it 50 naira. Then in December, the underlying asset becomes 20 naira. Mr. Peter is out of the money, because you can decide to, although you can decide to exercise your rights to buy or opt out of the option market. However, you will still pay what we call option premium, whether you opt out of the option or you exercise your rights. That is out of the money. Then, in a put option, is an option to sell. You've exercised your rights, Busayo. You've exercised your rights to buy UBA shares or to sell, because this is put option. To sell UBA shares. Let's say you buy the option today at 50 naira, the current price. You exercise your price. You exercise your right to buy it at 50 naira. Then you now say you will sell, not you will buy again. You will sell. Class, you buy it 50 naira. Is that not so? You buy it 50 naira, or you say you will sell it. Let me use that language. You will sell it 15 naira. In what? In December. You've exercised your right today that, oh, you buy the shares. The current price is 15 naira. And you say, oh, December like this, or more, I'll sell these shares. At least 30 December. Christmas is there, or more, we'll go flex. You buy it to sell in December. Then, in December, the price becomes, it is 15 naira. It now increased to 200. Busayo, will you exercise your right or not? Busayo, Are you still with us? You will exercise your right, Bashirat.
Yes.
Thank you. You will exercise your rights because you buy it at 100 naira. You buy it. Oh, this 312. Wow. You buy it at 15 naira in the option market, right? To sell in December. You buy it. Why did you buy it? You want to sell. You want to sell. So in December, the option, the current price of that option becomes 200. Or because we are out of the money, okay, let me use is out of the money. So the option of that price is now, let's say, is now 200 or is 20 naira. You know, it is 50. You bought it at 50, and December it now becomes 20. You bought it at 50. December, you want to do dirty December, and the current price of that asset becomes 20. Will you sell at 20? If you sell at 20, you make loss. Is that not so? That is out of the money. But whether you exercise your right or not, whether you exercise your right or not, you must pay premium. Option what? Option premium. In our next class, we'll continue from where we stop, which is option payoff. Class, are we still together?
Yes, sir.
Okay,
Yes,
okay,
sir.
okay. That's fine. So I think we have to go. All right.
Thank you.
Thank you.
So much,
Thank you
sir.
so much,
Thank you
sir.
so much. Yeah, thank you. Thank you so much, everyone, and for joining me. See you on Monday. Thank you. So thank you so much, everyone, for joining, and see you on Monday at 8:30 p.m. Right. Thank you, and bye for now. Thank you.
Au revoir. Bye.